Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with my good friend Doug Hagren. Hey, Doug.
Hey, Kirk. You know how you know if you're on the socials when you start getting complaints?
That's the only way to go. We're not getting hate, and no one's paying attention.
Yeah, if you're not getting hate, you're late to the party, right? It's what it's all about these days. So
I always love that that there's always some memes out there with like Jackie Gleason from like the Honeymooners. It's like, to all those who I've been pissed off today, I'm just about to get started.
that's pretty much what it is. Anybody who's in the social media arena that has any type of presence online, the smart ones recognize that they're getting feedback. I mean, Colin Cowherd talks about it all the time. It's like every time you disagree with me and you argue with me, I just makes more money. I don't care. Like I've got, what it says to me is I have engagement, and that's what it's all about. So,
yep, 100%. Well, we got a lot to go over today and not very much time. So I'm going to go over one framework right now and tell you a little bit why I'm talking about this framework. And then we're going to get into housing. There's a big revelation that we've learned, actually a few. And if you haven't been seeing this, we're going to start to get in some data. And we'll get into that in a bit. But first, I want to talk about where we are in the markets right now. So the markets, or at least let me be clear, the U.S. stock market has declined in the last week or so, and it's got a lot of people on edge. And I guess if you weren't prepared for this, then you're probably jumping out of your first floor window because it's only down like 10%. Although maybe it's 9% because the markets are up a little bit, but somewhere around 10%. That's officially a correction. When the S&P goes down 10%, it's officially a correction. And a lot of people are freaking out. Well, if you're freaking out for that and you weren't prepared for it, then sorry to hear. If you're all in tech stocks, sorry to hear. These things happen. They don't go up forever. I'll just tell you for reference, I was getting calls from some people who their portfolio was down 1% and they were freaking out. They're like, oh my God, the world's ending. I'm like, you do realize like the market goes up or down 1% in a given day. Like nothing's happened. Like this is like when the market started to crash and like, oh my God, like, okay, just settle down. Like we're prepared for this. You might not be mentally, but I bring this up because I've been hearing it a lot. And I think what people don't realize is that you can't have your cake and eat it too. If you want to get the S&P kind of returns, then you have to take the S&P type risk. If you don't want the S&P type risk, then you have to accept less than S&P like returns. Now, in general, if you look back decades, that's not a big deal because that's not necessarily what happened. However, in the last 20 years, it's all US all the time. So if you were international, you would have underperformed basically for the last 20 years. But if you were in the US, you would have outperformed. Now, there were decades where international outperformed the US, and we might be entering one of those 10-year cycles where international outperforms the US. But we haven't seen it in so long. We have a whole generation of people for decades who've never seen that. And they just put all their money in tech stocks because that's the only thing that worked. Or let me rephrase that. It's the only thing that worked the best consistently. If you just put all your money in the Mag 7 and just left it, you would have done great. I don't think that's a good investment strategy, but if you had done that, you would have done great. Now, it doesn't mean that that's going to continue. And certainly we've seen signs of that where it's not continuing right now. We've seen signs of the markets rolling over, and the U.S. markets, at least the S&P, was down about 10%. I think at the low point, it may have gone a little lower, but I think the low point that I saw was somewhere in the. Come on, well, I can't see it. It's not there. It is like 10.13% or something like that. No, it might have gone lower, but that was just one of the charts that we'll share today. That's not a big deal. I don't know if, for people who've been listening to the show for a while, you've probably heard me say that I think we could very easily have a 30 to 40% correction, because the market's so overvalued that a 30 or 40% correction would be normal. We were so overvalued that if we went down 30 or 40%, we'd be in a normal range. It's not even bad. That's just like, yeah, okay. We're back to normal ranges. It doesn't mean that the market's going to crash. It doesn't mean the economy is going to crash. It just means that, okay, we have now normal pricing and we feel good about, stock picking good stocks at a good price. But people would freak out because they're like, oh my God, I lost 30 or 40%. Yeah, but did you really? If you looked at the highest point in the market and said, I'm on top of the mountain, and then you start going down the other side, we're like, wait, I'm not on top of the mountain. Well, yeah, but you were, and it's kind of like, well, it doesn't really matter. All that matters is what's the money worth when you take it out. So if you have an IRA and you put in $1,000 and now it's worth 100,000, you're like, I'm on top of the world. And then it goes down to 90. You're like, oh my God, the world's ending. It's like you turned $1,000 into 90,000. I know it wasn't 100, but now it's 90. It's still a lot of money. So I'm not saying this to justify the markets being down 10%, because once you hear what we have to say, it might freak you out. But the point I'm trying to make is you have to have perspective. You have to have a perspective in a context of the way things work. It's like going to the casino and you go with 100 and you're up $1,000. Yeah, I'm on top of the world. And then you lose and you're like, oh, I only made 500. It was a bad day at the casino. What do you mean a bad day? You turned 100 into 500. It's a great day. So what if you didn't leave with 1,000? You still made a lot of money. And I think this is the mental model a lot of people struggle with, is they struggle with the fact that they look at the high point and say, that was my money and I lost it. No, it was never your money. It was never your money until you step back from the table and said, all right, I'm done. Then it's your money. So as long as you're in the markets, it's always going to fluctuate. And if you really torture yourself with this ridiculous thinking, and we all do it, and so just understand that it's human nature to do it. But if you torture yourself with this, you're never going to be happy with your portfolio, and you're probably never going to have success, because even if you make a lot of money, you're going to be stressed out. And then I always come back to this term when I talk to my clients, like, what good is a pile of money if your life stinks? Right? Okay, you're up, you have $10 million, woohoo, but you're stressed out and you're about to have a heart attack. What good is that 10 million if you die? It's not good at all. What good is retirement if like you're running a business? Let's say you're running a business, you're doing great, but your wife divorced you, your kids hate you because you never see them. Like, your life's a mess. Oh, but I have this successful business. Well, okay, if that's what's important to you, fine. But if your family's important to you, then your life stinks. So, not saying money's not important, it is, but you have to keep things in context. So I want to use this frame to talk about this one Wall Street quote that I have on pretty much every single podcast on our website, which is Ray Dalio saying cash is trash. And while in one context it's true, in another context it's untrue. This is what we call a half-truth. Sometimes it's true. And because it's true, sometimes you naturally think, oh, yeah, it's totally agree with Ray. Yeah, he's a really smart guy. Yeah, cash is trash. Why? Well, if you don't understand, I'll explain. The reason he says cash is trash is because over time, inflation will eat away at your cash. So if you had 100 years ago, $100, it's worth like $2 today in purchasing power. So cash is trash. Yes, if you want to hold cash, if you want to stick it in a bank vault under the ground for 100 years, yeah, it's going to be worthless in 100 years. Absolutely. Terrible investment. However, if you have cash for like a day or 30 days or a year, it's not the end of the world. Right now, cash is paying 4.25%. That's not bad. I don't think it's going to keep up with inflation, but it's not terrible. So is cash trash? Well, let's see. Let's compare them. On the one hand, let's say you're holding cash for a year. Okay. And let's say the year ends today, because I know we're 3 months in and a lot can happen in 9 months. But let's say December 31st is today. The market's down 10%. If you had held cash all year, you would have made 4.25%. If you had held the market all year, you would have lost 10%. Is cash trash? No, it's not. Because you outperform the market by having cash. Now you might say, well, over time. Yeah, over time is irrelevant. Do you live forever? No. So over time is irrelevant. Because what matters is when you take the money in, or when you pull the money out, when you put it in. So if you're just going to ride it for the next 50 years and you don't care, then it doesn't matter what the market does. But if you're looking at it and you're saying, hey, I'm going to retire in a few years, and the market's gone up a lot over 10 years and it hasn't had a bad year in a long time, I'm worried. Maybe you should take some money off the table. Maybe you should put money in cash in U.S. Treasuries or CDs or something to keep it safe. Because you don't need to keep making more money. And if the market keeps going up, great. You can find ways to do that. The point being is cash is not trash. Cash is a position. It is a investment option for the right time. Because if you look at 2008, it was down about, from peak to trough, it was down somewhere around 58.5%. Let's say 50, just to round the numbers up, make it easy. 50%. The market goes down 50%. It turns your $100 into $50. Now, what if you held cash? Well, before that, I think cash was paying something like 4%. But let's say it was paying zero, because at the end of it, after the crash, it was paying zero. Let's say it's paying zero. So at the end of the year, you have $100 versus someone else, they have 50 because they were in the market. So now that person who has 50 who's in the market, well, now their stuff is worth half. But I still have my $100, which means my cash appreciated by 100%, because now I can take that $100 and buy twice as many shares as that other person. Let's say that other person's Doug. So Doug has $50 in the S&P. Now I have $100. Now I can buy two. I can buy 2 shares to Doug's 1 of the S&P. I doubled my investment. Well, Doug, in comparison to Doug, right? Everyone else loses 50. So in my comparison to everybody else, I doubled my money. Now, it doesn't show up as a double on your statement, but it didn't get cut in half. So now when the markets go back, as they inevitably probably will, now my investment's worth a ton more. And now I have twice as much as Doug, just because I didn't lose half when he did. So keep in context the context of how you're looking at cash. Cash has a strategic value. And you might want to think about this in the next year, because we're going to keep, this week we're talking about real estate, but we're going to start talking about the paradigm shift we talked about before. I was thinking of pivoting back, and then I got deked out, I got faked out, and I think my original thesis is still sound. The markets are going to be confusing a lot longer than most people think. And we're seeing that right now. Is inflation getting you down? Do you feel like your money is worth less every time you open your wallet? Is shrinkflation frustrating you at the grocery store? Well, I have an answer for you. We're giving away free money. That's right, I said it, free money. I feel like I'm not doing my part to create inflation. Why does the government get to have all the fun? What could be better at increasing inflation than giving away free money? No, I'm not an employee of the Federal Reserve. And no, I'm not an employee of the US government either. And no, I am definitely not printing it myself. But it's free. What more could you ask? Well, you might ask, is it real? Well, yes, it's totally real. I'm holding it in my hands right here, see? Oh, wait, this is a podcast. You can't see it. Either way, I'm holding it in my hands right now, and I want to give it to you. If you want some free money, go to moneytreepodcast.com/free money to get your free money today. Follow the instructions and I'll send some to you. Enjoy your free money today. I'm not the Federal Reserve, so I only have a limited supply. This offer is good until I run out. Go to www.moneytreepodcast.com/free money to get your free money today. So let's move on, because we're going to come back to that in subsequent weeks. But right now I want to get to real estate. So Doug, prep us on real estate. What's going on in the real estate markets right now?
Well, a lot of things that are happening in real estate. We have run into a situation in real estate where they have identified a significant potential support level that was given to maybe some of the uh, natural market movements that would have occurred in real estate based on some extended COVID level support. And as it turns out, what we're actually running into is that the FHA loans are running into a situation where they have about a $1 million FHA mortgage borrowers are currently in default. That leads to about a 14% default rate, which would make it one of the highest ones in history. The argument, or at least what they're discovering, is the U.S. government's been artificially propping it up by covering mortgage payments for those that are in default. Again, the argument being using taxpayer money. Wall Street Journal came out and said that this mortgage relief program, they argue, could trigger a major housing meltdown. Basically, what happened is they used this extended COVID era support structures to keep hundreds of thousands of foreclosures from hitting the market. The argument here is, did that officially limit housing inventory and prop up home prices? But they're also taking the mortgage payments that were defaulted and tacking that unpaid debt onto the loan balance. They're now allowing loan borrowers with as low as a 580 credit score to purchase homes with just 3.5% down. We have about 66% of FHA borrowers that have a debt to income ratio above 43%. Now, if we go back, probably I'm trying to look here, maybe the early 2000s, that was as low as 25%. So right now we're facing, a lot of homes where half their income is going toward debt payments. So when you look at that, we are facing a scenario that looks a lot like the subprime crisis of the 2000s, but there's some other risks there's some situations that are better, but there's also some risks that are worse. At the same time, you've got Blackstone dumping a tremendous number of homes too. They're getting out of the investment home space, but we're looking at possibly around 400,000 foreclosures that are backlogged due to the government intervention. Where that's happening the most, and of course, where you might see some of the biggest price corrections, is still going to be geographic. And so the question is this going to be a broad spectrum, housing correction and collapse? Now, obviously, if with this information now public, the current administration could choose to pull the plug on the program. If that happens, foreclosures could start flooding the market. Housing inventory could spike. Prices could drop significantly. Still think that's going to be in certain areas, and some of the biggest areas of concern are going to be in larger FHA markets, places like Fort Worth, Texas, Las Vegas, Orlando, Phoenix, certain cities in California like Riverside, Houston, Birmingham, Alabama, South Atlanta, Georgia. Those are some of the areas that look like they could have some of the biggest concerns and already seeing some of the biggest corrections. We have, the home builders were really continuing to just dump a lot of supply on the market. Now there's a question of whether or not that was propped up too. Home builders like D.R. Horton have sold, they've discovered have sold 60% of their homes to the FHA and VA borrowers. So what does this mean? I mean, there's a good chance the prices are going, especially if they start to put, a supply demand back into place, prices are going to drop in especially FHA heavy neighborhoods. But that's also going to open deals potentially. So for people that have been looking, because we've got a supply issue. I mean, that has propped up prices for sure. That has also made it very difficult to find homes. A lot of the real estate bulls like to talk about, but look, housing prices are still going up. Well, yeah, that's because when one home hits the market, you're going to have a lot of people who are going to be trying to buy that home, even if the total number of buyers is squeezed out because of current interest rates and pricing. So you may start to see then some deals in new build communities. You might start seeing slashing prices on those. If you are someone in an area with a high FHA loan usage, you may want to, and you're considering selling, you may want to look at selling sooner than later. But you got to monitor those inventory trends really, really closely. The fact is, this bubble is real. It's clearly evident now that there is a lot of struggle in the support of payment and financing of homes that are out there, and homes that would have hit the market had they not been given, consistent reprieve. The builder inventory charts highlighting 120,000 unsold new homes, which is the highest in 2009. You add in those 400,000 delayed foreclosures and where they're concentrated, then yes, you are. I mean, I think it's be hard to say there is not going to be some backlash to this if it comes out. There's not going to finally be some correction of price in certain areas. You just cannot have that many things that go into the cycle that increase supply, even if demand is there, until they come back to an equilibrium. So, again, it's going to be regional most likely, but expect that that's going to have an effect.
Yeah, I think the challenge. I mean, I feel like we've had a scandal a day about what happened in the last 4 years under the Biden administration, and I'm not sure if this is all tied to him or not. I mean, COVID was COVID, so let's just say what it was. But I think, when you're seeing this stuff come out and you're seeing people who are basically kept in their homes and the government's making payments to keep them in their homes so it doesn't show up in bankruptcy, so these homes don't hit the market, there's a bit of empathy towards homeowners, right? Which I get. I mean, look, if I was in a crappy situation, I'd want people to bail me out too. But that has broader repercussions, which we are starting to see. I mean, it says here the NBA says taxpayer welfare, basically 8.5 million homes have been artificially kept off the market.
And let me add, MBA is Mortgage Bankers Association.
Yeah. So thanks, Doug. So 8.5 million homes. We have this huge deficit of homes that are, off market that need to be put on. People need to be buying these things. People need, like, yeah, I look at my neighborhood and I'm looking at this stuff. I'm like, nobody can afford this stuff. You're seeing Florida, you're seeing Texas, prices are starting to come down hard. Those were rapidly growing markets. I remember this because I remember back in 2007 and 8, and actually started in 2005, I think was the peak. And then like 6, 7, 8, when house prices really started to drop, like it got ugly. If you didn't remember that, go watch The Big Short. It got ugly fast. And they really don't get into that part of it. They get into everything leading up to that, and afterwards you hear a little bit, but it's not like the whole thing. I'd really love to see somebody like go through the whole thing and be like, yeah, this is what actually happened. Holy crap. I remember that period very keenly. And, I wish I was sitting on a pile of cash to go in and buy property. We just weren't in that kind of position. I wish we were. But had we been, I would have run around like a kid in candy stores. Great opportunity. Now, what we are seeing or have been seeing since COVID, and we've been talking about in the show a lot, is this weirdness of you typically have interest rates going up, prices going down. That is a natural pricing mechanism that happens in any sort of bond market, right? If you have the bond market, yields go up, prices go down. Prices go up, yields go down. It's an inverse relationship. It's how bonds work. Bonds also typically have an inverse relationship to stocks. Stocks go up, bonds go down, vice versa. That's a typical relationship. Now, that relationship broke in 2022. Was it 22 or 21? It's 22, yeah. 2022, that relationship broke where everything went down. Stocks and bonds went down. It's crazy. Like people were like losing it. They're like, where do I go? I'm like, I don't know, cash. Like it's just like it's kind of like in 2008 was similar where everything was going down. You didn't know what was safe. And it wasn't like bonds weren't safe. It was like, are my bonds safe? Is the money, am I gonna get the money back? Like it was a crazy time. So I only say this to say we've been very fat, dumb, and happy. I'm gonna have to come up with like an acronym for that. So FDH. It's gonna be my new thing, FDH. But if everyone's FDH here and they're just sitting here like, everything will be fine. Well, what if the market goes down 40%? Now, we've talked about this in the past. I think it's possible that the markets could go down 30% this year, maybe 40. Do I think we're going to have a crash? I don't think so. We could have the next few years being a crash, like 2000 to 2003. It wasn't a crash. Like some parts were, but it was basically like a slow grind lower over multiple years. Even though it didn't feel like a crash is 2008. Crashes don't happen that much. 87, 2008, like those are crashes. COVID. Mostly it's like 2000 to 2003. Like that was like basically a downward slope where you're going down in your go-kart with no steering. You're just like, woohoo, no helmet. That's what that was like. And we're having a topping pattern right now, in my opinion. I think the markets are topping because you have US markets that are down this year. International markets are up like 15, 20%. Europe, they're up 15, 20% for the year. It's crazy. China's up big, right? I should probably try to share the China chart. It's up big this year. Let me see if I can find it. It's right here. But anyway, so here it is. Here's China compared to the US large caps. So it's a ratio. It's going through the roof, right? And that's China large caps, right? So I'm not saying China's back on the scene, but they're certainly not hurting compared to us, right? They're definitely going up in comparison. Actually, even if they were flat, it would still look good in comparison to us because our markets are going down. But point being is you need to protect yourself, right? And if you're not prepared for a 30% drop, then you really need to be paying attention. Now, if you're just starting out and you got $1,000 and you're just investing like $100 every month or whatever it is, don't worry about it. Just make sure you've got some extra cash if it does crash. But if you're at the beginning of your journey, just keep investing because it's not going to move the needle that much. But if you're close to retirement, you should be turning down the risk. If you knew what we had in our portfolio, you have to pull your chin off the ground. Like we are very conservative right now, because not only am I afraid of where the markets are going, I'm afraid of what the next 12 to 24 months are going to hold. And I want to make this point, and I'll get back into the real estate part. You have to. So there are a lot of people in this country, a majority, that are very happy that Trump won, right? Majority of the people voted for him. A lot of people are happy that he won. And there's a lot of people that are very unhappy that he won. Okay. And those people are probably not listening to the show. There are some that do, but I think we have a different tone. So I think some people are, unfortunately, it's apocalypse porn for people who are anti-Trump. But I think the thing you have to think about is this. And this doesn't matter if it's Trump or somebody else. Even if Kamala had won, it didn't matter. And I've said this in the show. It doesn't matter who wins. They're in for a heap load of trouble. And I was, in the back of my mind, I'm thinking like, oh God, I hope it's not, because I wanted Trump to win. Like not because of who he is, but I just think the other alternative would have been worse, which is unfortunately how most people make their decision. But I said it doesn't matter who wins. They're in for problems because the economy is really teetering on the edge. And what Trump's trying to do is disruptive anyway. I think they're all mostly good so far, and he'll hit some rough patches, I'm sure. Mostly good, but it's also going to cause problems. I've got people complaining. They're like, is my Social Security going away? I'm like, I don't think he's ever said he's going to take away Social Security, but that's what the news is telling people. They're telling people that, and they're freaking out, right? So people are going to start to make irrational decisions in the market, which causes the market to sell off. And so what I think you have to keep in mind is that you need to really remove politics from this. You need to stop watching them. If you're watching corporate media, just stop. There's nothing useful on there. Nothing. All they do is propagandize you in their own direction, whether it's Fox or MSNBC. Doesn't matter which one you watch. They both do it. Just stop watching it. There's no value in it anymore. There used to be, but not anymore. Now they're just propaganda. Now they're trying to clickbait you. That's all they're trying to do. That's how they put food on the table for themselves, is getting eyeballs and freaking people out. So just stop. Like don't look at them for information. Find good independent media, that's trustworthy. That's not, getting paid by advertisers to punch their products. So here's the thing. You need to disconnect the stock market from your feelings about, the direction. Because I think in general, directionally, we're probably going in a better direction. The economy and the stock market, I think we're in for a rough patch. You have to be able to disconnect that. Because if you can't, you're saying, well, Trump got in, the stock market's going to crash, or Trump got in, the stock market's going to go through the roof. You can't think that way because that's not how it works. The president has almost nothing to do with the stock market. Now, there is something they can do, right? But most presidents through history, if you look back, there's very few presidents that have had any impact whatsoever on the economy or the stock market. Very few. There's some good and some bad, but very few did. So you can't look at it as the president is going to dictate how the stock market works. If you love Trump, don't think of it he's going to save the stock market. He won't. If you hate Trump, don't think he's going to crater the stock market. It has nothing to do with it, right? It's disconnected. There's very little correlation. What you need to understand is the stock market is going to be in for a rough patch, and we're going to talk more about this in subsequent weeks. But the real estate market, I've been reading about this lately, and I'm like, holy crap, we have subprime 2.0. And there's been some great people have done some great research on this, but I remember the housing market, it was bad. And what they did prior to that was bad. And the fact that Biden's doing this is no surprise because they're doing that for paying off college loans and all this stuff. It's not bad that you're helping people. What's bad is there are always unintended consequences. And what this appears, so the reason we had the housing bubble, or one of the major reasons, was because they allowed people into homes that shouldn't have bought homes. That was really what happened, is the government changed the rules and allowed people to get homes that shouldn't have had homes because they couldn't support the home, caused people to go into foreclosure and bankruptcy and all that. And it caused massive problems because the government said, oh, we should just let everybody have a home. No, not everybody should have a home, because if you can't afford it, you don't deserve a home. Like, you build your wealth up or income up so you can afford it, and then you go buy one. That's why people are allowed to rent. Renting is for people who want to rent or can't afford to buy. Anyway, point being is every time the government gets in, it screws things up. And this seems to be what happened. The fact that we had so few homes on the market for the last few years, and I'm sitting here scratching my head. Doug and I are like, why does the real estate market keep going up? I don't understand it. There's so few homes. And it's like, everybody keeps saying, well, it's supply and demand. I guess technically they're right. When you keep homes off the market, it artificially inflates prices. And now, as some reported, Blackstone selling houses 70% discount, like 75% discount or something like that. I think that was one of the stories. Like, okay, maybe that's true. But the point being is I think we're in for a rough patch here with housing too. So stock market could be a rough patch. Housing could be a rough patch. What's safe? I don't know. Gold's at all-time highs. Who's talking about gold? No one. No one's talking about the gold bugs. I'm sorry. Sorry, gold bugs. You're always talking about gold. I got to give you credit. You're always pro gold. But
shout out to Peter Schiff.
Yeah, hey, we don't say that name in the show, Doug. That's on our blacklist. We don't say that. Anyway, so we have those who've been following the show know what we're talking about. So anyway, so gold's doing great. You know, Bitcoin, Ethereum, some of the cryptocurrencies. Oh, they're down 20% off the highs. Who cares? You know, they're not at all-time highs, but they're still up a lot of money. I don't know if those will continue to do well. If we have a sell-off, I think everything will go with it. But the point you have to take away from this is you have to start looking outside the Mag 7 box and invest in other places. And if you're looking to buy a home, like we're looking to buy a home right now, and I'm sitting there like, yeah, I want to buy a home, but I'm seeing this. I'm not liking it. Maybe I want to sit on my hands for another 6 months, see what happens. Just be patient. If you have cash, love your cash. There's nothing wrong with cash. I just talked to somebody who that person had a lot of cash, and they're like, oh, I'm afraid you're going to dump at the market. No, I'm not. I'm not going to dump in the market. I'm probably going to sit in cash until I see some opportunities. Like I'm not, like we want to see things. We want to see opportunities. And right now we're not seeing them. So until we see that, we'll be a pig once we see opportunities. But right now it's like we're in a topping pattern, which could last for years. This could be the top, and we might not see the top again for another 3 to 5 years. I don't know. I don't think it'll be that long. It might be 2 years sell off and then we'll head back. I don't know. I can't predict the future, but what I am predicting is, holy crap. I am starting to be afraid, and it's not because it dropped 10%. I was feeling this before, and I was like, why is the market still up? Why are people not selling off? It doesn't make any sense. Now I'm starting to see the data, and I'm starting to get a little freaked out. So, we're pretty conservative right now. I'm okay. I'm okay sitting in my hands and just waiting this out. But if you're thinking that this is a good buying opportunity, you could be right. But just be very careful, because all the signs I'm looking at are pointing to, go sit in your bomb shelter with your MREs and golden guns and just wait it out. You can still make money in this market. To be clear, when markets go up, you can make money. When markets go down, you can make money. You don't have to short the market. There are plenty of reasons and ways to make money when the market goes down. You don't have to short it. You just have to understand bear markets, because they're different. So I don't know. What else we got, Doug? I mean, what else in the real estate market, or what else should we talk about before we kind of wrap it up here?
Yeah, so I got a couple things I thought would just be kind of fun to go through. Now, first of all, I want to come back to something you said early on in the conversation, where you're already getting calls with this quick move. Look, if you're thinking with all the little that's actually happened in the market so far that you need to call and worry, the problem is not the markets. The problem is that you're watching the news too much. Okay, because there's just all this terrible stuff that's going on, and the president and tariffs and this and that's happening. Look, the reality is, the market has pulled back a little bit, but we're still kind of where we were at the end of 2024. So it's not a major deal. I think, there's certainly some arguments like Kirk's saying about how it could, there's other variables at play that could lead to something that could pick up and reason to be concerned, but not based on what's just happened. So if you're worried about what's just happened, your problem is the news. I think, some of the things on the supply, I want to go back to the real estate. If it hadn't been manipulated, listen, we've said this for a couple of years. We've been doing this together, Kirk, is that everything's been up, was propped up by a significant amount of cheap credit and cheap money. Okay. That cheap money changed, but yet we didn't see anything occurring to unwind the growth that was happening from that cheap credit. And I think now we're starting to see kind of what happened. I mean, if we didn't hit this 8.5 million supply of homes wasn't manipulated, instead of peaking in 2022, home prices could have adjusted gradually, making housing more affordable. The other thing that people don't recognize in that is that by keeping housing pricing arguably artificially elevated based on the supply, based on these homes that should have come available, it not only affected the housing supply, it affected real renting. Because remember, if people couldn't get a home, now you have more people that were trying to go rent. And what did that do? That pushed up rent prices. So this inflationary scenario hit both of these things. And if it starts to unwind, if we start to move, what we start to see is potentially you could see 20 to 40% prices in FHA heavy areas move. You could see more foreclosures. That's an inventory spike leading to faster price declines. You could see a psychology shift that could go from no sellers to everyone selling. Because right now everyone thinks prices will stay high, but once we see this even in the stock market, what happens, Kirk? The market starts going down and then it picks up speed because you get this fear of missing out that goes both on positive greed, but you get this fear of missing out that comes on negativity. So once supply starts increasing, sellers panic. That creates a feedback loop of lower prices and inventory. You could see a 2008 correction in FHA hidden areas. Long-term impact. Well, the issue is we could go from scarcity to oversupply. Investors start to see them exiting the market more. Real estate, mortgage prices continue to stay high, which would certainly potentially lead to continued issues on affordability. But we've seen the math. When interest rates are here, this is what you can afford. We should have seen home prices adjusting according to the fact that banks would only approve people on debt to income ratios. That has not occurred. They've moved that needle. And when they moved that needle, that led to more people being able to get homes that, again, like you said, they shouldn't have gotten, that they couldn't have afforded at higher rates and at higher prices. And that is the real, that's like the sewer soup, because now, you basically have higher prices per month that they have to handle on that debt to income against an artificially increased price of home that they had to buy in the first place. And it is, unless there is the support that's going to come that has kept them out of trouble, Now you're leading into a situation where it exacerbates and creates a bigger problem when these things start to come out. But I want to leave with a couple of things that I think are really kind of interesting plays for the end of the day. Do I think that there's going to be a housing apocalypse? No, I don't. But I do think there's a hard reset coming, especially in those hidden areas. I think the artificial inventory suppression delayed a correction. I do think one thing that they're not still pricing into all of this is the fact that people have held onto their homes because they just feel like there's no better choice, right? I was like, I'm already in a low interest rate or it's paid off. Where would I go? Anything I buy now is going to be more expensive. I still don't think that anybody or not enough people are pricing in the eventual death of the baby boomers. Okay. They were the ones that have invested in some of the largest and most expensive houses, and they still hold those houses. And they may want to downsize, but they're looking like where? But eventually the clock stops ticking. Okay. And when people start to die, they can't keep the house anymore. And that's happening. The baby boomers were the largest population until the millennials. They're starting to unwind a little bit on that, and we're starting to see that population decline, but they still sit on some of the biggest and most expensive houses. The problem is the next of kin, A, don't want those homes. They want smaller homes, easier to take care of. They want to be more transient. B, they can't afford them even if they want them because you still have higher property taxes. And by the way, that's another thing that we have a chart on that shows the amount of property tax income and revenue to municipalities that has gone up over the years. I can tell you from personal experience, I bought my home for $575. They immediately told me I was paying taxes on $675. It's like I bought it for $575. That's what I should be paying tax on. They were like, well, that's too cheap. It is what it is. So, but these governments have just gotten rich and frothy off of the property taxes. You start to see that reset. There's a trickling effect from there too, because they, unlike the federal government, can't print revenue. So, I think, we've got to, inflation. I want to talk about a couple of things. I'll go through this really quickly. I think the housing will correct. I don't think it'll crash, but I do think localized drops. But I do think that there's more to come from other areas like the death of the baby boomers and impact to municipalities from that. I do think tech stocks are going to continue to see volatility, but I think AI is going to keep that propped up. By the way, America is not dead. The U.S. stock market, still think is one of the best games in town. And I think this is something that Trump is playing off of. Okay. Europe and Japan still have structural growth issues. Emerging markets are always more volatile. We still have some of the most innovative companies like Apple, Microsoft, NVIDIA. AI is real. Listen, the U.S. companies lead in AI, biotech, and energy. Guess how much Europe is trying to get above in percentage of the world? 1%. Europe hasn't even figured out how to get 1% of the impact on AI, biotech, and energy. So Europe is still extremely behind when it comes to where the technology is going and where the leading companies are, which means international exposure is good, but still be cautious. Inflation's going to still be sticky, but I don't think we're going to continue to have hyperinflation. I think the economy will slow. I don't think it'll implode, but I do see what you're talking about. I think a 30% decline in the market is absolutely possible as we start to unleverage a lot of the real things that came from cheap and easy money. And then I want to come back to it. The American dream argument is dead. Okay, the rich have already left the U.S. The economy's rigged beyond repair. We still lead in entrepreneurship, AI, defense, and innovation. The wealth inequality is real, but mobility exists. Businesses are still growing. Wages are rising. New industries are emerging. If we were collapsing, here's a major question. Why is global capital still pouring into U.S. assets? We still offer more opportunity than most places on earth. This end of American narrative is mostly doom porn. And we need to focus on what's broken, but smart investors need to focus on where opportunities are, and they still exist. So, from that aspect, I think, again, the news is really stoking these fires. I do think that a lot of our presidential positioning right now recognizes a lot of the facts that I just said. And because of that, I do think that he's a master negotiator, and he's going to use this to negotiate things that are going to benefit the United States in areas where there'd already been a we've been out of balance. Things like tariffs. Rest of the world has had significant tariffs on a lot of our stuff for a long time. But that, now how do we even that? I don't know if there's a perfect answer. The other thing is, I do think that you should stay the cash idea. I do think you need to be cautious right now. But like Kirk was just saying, there are other places to invest. Hard assets, our defensive stocks, there are inflation hedges, things that perform more even in these. So it's not just run for the hills and be fearful. But I'll leave it with this. Warren Buffett has $380 billion in cash. If cash was trash, and who's considered the greatest investor of all time, arguably, is sitting on $380 billion, I don't think cash is trash. I think if you're a dollar cost investor and you want to be opportunistic, the thing that cash gives you is, as he says, the ability to have choice and flexibility tomorrow. And a lot of people don't have that. And so if the markets do drop by 30 to 40%, that's when hard choices need to be made. So don't put yourself in that position.
Awesome. Well, we're going to wrap it up, Doug. And I forgot about the Buffett thing. Yeah, he's got his largest cash position ever. And I think the smart investors are sitting on the sidelines and just saying, all right, we're just going to watch. We're just going to watch things unfold and see what happens and look for opportunities. And I think if you're smart and if you're listening to this podcast, you probably are. Don't be afraid to have a pile of cash on the sidelines. If you got a big cat. One of the biggest challenges we see is when people have really low cost basis positions, and they don't want to sell because they're afraid that if they sell, then they're going to pay a lot of tax. Let me tell you something: if you pay tax and you pay 20% tax, and your stock goes down 20%, it's the same thing, right? And if you want to hold the stock forever, okay, you can decide. If you're looking to hedge the downside and protect the position and you don't want to sell it, come to us. We'll help you hedge that position. We have plenty of things we do to help you do that. We're actually doing that with a lot of portfolios right now and hedging out positions to reduce the risk for people that still want to hold. But in general, you want to just be really careful during this time. So Doug, where can people find more about you?
Well, I appreciate it, Kirk. I want to say one thing really quickly about the if you have highly appreciated assets, there are some things you can do, strategies like direct indexing, where you can use tax loss harvesting and ways to start to deleverage that. So those are things you can look at too to start to get away and potentially minimize, or if not eliminate, the capital gains on deleveraging exposure to highly high concentration of an asset. So that's something to think about. The other thing I wanted to bring up and appreciate it is take a look at our website. So yes, we do advice for affluent families, but we also predominantly look around college planning. So we are working on a lot of strategies that deal with tax strategies, that deal with investment and saving strategies. Ultimately, at the end of the day, there's a couple different types of people out there. Those are the people that can't afford college, and there are the people that can afford college. And those that can't afford college, the issue is they tend to be a huge exposure, an exposure to the tax side of it, because a lot of them are paying with after-tax dollars. Ultimately, the reality is many of their kids are going to go to more expensive schools because of the way the system is stacked, and also high achievement. So we actually have a webinar that we put on. We got 2 more this month. The next 2 Tuesdays. If anybody has a question, reach out to me at douglas@mergentgroup.net. It's MERGENTGROUP, mergentgroup.net. We're going to be continuing to put these on, but how to secure your child's future without sacrificing your wealth. Some of you that have kids who are high school, they're looking at college, have probably been on webinars before. One thing I can tell you is you're going to hear some things you've heard. Some people are going to hear things, the whole thing they've never heard. But what I can promise is there are things in this you've never heard anywhere else. And we're getting told that by everybody who's listened to us, because we really get into focusing on what the 80% of what you should focus on is. And that is not just strategies for saving on, not just strategies for saving for college, but strategies for saving on college, and how to not lose money unknowingly and unnecessarily in such a major, costly endeavor. So if you want to maximize your wealth and not sacrifice it and be a smart money family, you're going to want to get more information. You can either talk to us directly or feel free to join one of our webinars, and we'll get that information to you if you're interested.
Great. Well, thanks for coming on, Doug. We didn't have enough time to talk about the new Bitcoin reserve conversation. We'll talk about that next week. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.